Welcome to a video on how to get approved for gap funding and really what to do if you're not ready yet. So before you make another offer on a property, before you even start talking to your hard money lender, you need to know what your funding profile actually looks like right now. So today we'll show you exactly what gap funding lenders look at, what gets you approved and what gets you declined, and what to do if you're not quite there yet. There's a pathway for almost everyone, so you just need to know which one you're on. Let's get into it. I'm Mick Wadley, founder of gapfunded.com. Across our network now, we've helped over 5,000 investors and business owners access the capital they need to close. So the number one question we get every single day, Nick, would I qualify? So this presentation is going to answer that exact question, and more importantly, tells you what to do if the answer right now is not yet. So let's get fair up it. So what is gap funding? What do gap funding lenders actually look at? So gap funding is unsecured capital. Important to understand that. No property, no collateral. The lender is betting entirely on your personal profile, and here's exactly what they assess. Now, I just want to address that before we get in here. So many people come to me every single day saying, Mick, I'm looking for a second lien, an asset-based second lien on my hard money. Mate, your hard money lender is going to pull their approval if they find out you've done that. Usually the only circumstance you're going to be able to pull that off is through the hard money lender. So ask them. It's pretty rare. Or they're looking for private money, mate. If you don't have relationships, build those up over time. Fair enough. Go and get 20% equity partner for a 4 to 6 month flip. That's 40% annualized. It's very expensive capital. And the last one is, seller finance, sub 2, these creative financing strategies that are 1 in a million. Great if you get them, nothing wrong with them. But if you're not wholesaling full time, I don't know how you're going to scale using that. So let's get into what gap funding actually is and how to use it in a way where you scale consistently. So if your credit score's at 700 plus, this is the prime tier. Lenders compete for your business. 650 to 699 still works at lower amounts, but below 650 means a different pathway and not necessarily a dead end. Number 2, credit utilization. So high utilization signals financial stress. Ideal is under 30% across all cards. So this isn't just your average. We want to get them all under that 30% across your personals. Under 10% is even better, but we run it at 30. Now, verifiable income is another thing these lenders are going to look at. So you can't just tell them, yeah, mate, I make 500 grand a year. They're actually going to look at the last 3 months. They're going to hook Plaid into your account, figure out on average, do you make what you put on the application? So your approval amounts are going to be tied directly to that income. Typically 40 to 50% of your annual income's baseline. If you're applying in the right order to the right lenders. So 100K a year, 40 to 50K gap funding stack, just as an example. Now, debt load and derogatory marks is the fourth thing they'll look at. High debt to income ratio reduces your ceiling. Recent late payments, collections, or defaults create hard stops. So patterns matter more than isolated incidents. They're going to look at the conglomerate of all these factors. So we can't just say, yep, you're 700, you're going to be approved. We'll never say that. We're going to look at your entire profile to understand exactly what your best path is going to be. So strong profile versus a weak profile. Here's what each tier looks like in practice and what outcomes to expect. So a strong profile, score 720 plus, utilization under 20%, income over 80K verifiable, no recent marks. This is a great file, and your result could be 40 to 100K stacked, approved in 24 to 72 hours. And then you're ready to go straight into 0% business credit card stacking, liquidate that into the backup cash reserve as you move through the project. Or as you've bought that first business or franchise and need that working capital to start employing people and get pumping. So a moderate profile will be 650 to 699. This is where utilization is typically high. People coming to us in this situation, 80% of the time they've got a few overutilized credit cards, personal credit cards, maybe a couple of auto loans. Your income would be sitting at 60K verifiable, older marks only. The result here would be 20 to 40K approvals, more structured, but deals are still getting done. Now, if you're not ready, there's still a path. If you're 650 to 669, utilization's really high. Some recent marks or high existing debt consolidation and gap funding can actually happen at the same time. So not come back in a year, it's a specific structured setup. Let's have a look at that debt consolidation and gap funding pathway. So most funding companies only have one product. They might be an SBA funder, they might run merchant cash advances, and if you don't fit into their little bucket, they tell you to piss off down the road. gapfunded.com has a pathway that does two things simultaneously. Consolidate your existing debt and build the gap funding at the same time. So we're going to consolidate that high interest credit card debt, roll it and personal loans into one single fixed rate line, clearing of revolving balances and lowering monthly payments. So this is going to free up cash flow. We're getting an immediate credit profile impact because utilization accounts for about 30% of your FICO score. So when utilization drops dramatically, the score will jump within the 30 days as soon as that reports onto your credit report as an improved debt to income ratio. And then we're building funding access simultaneously. So an initial gap funding product is structured alongside the consolidation. We're using that to consolidate, get into the deal. 30 days later, we're seeing clients jump from that 650 mark well into the 700s to be ready and be in a position to go and stack those 0% business cards to really have that backup capital and even take on opportunities while they've got their liquid cash tied up in a deal. So how do 0% business credit cards fit into this whole play? The business credit layer, once personal credit is clean, utilization's gone below 30%, we've done with the debt consolidation, the scores jumped up over 700, no recent marks, you're ready for the most powerful layer. So business credit cards with 0% introductory APR for 12 to 21 months don't report to your personal credit file. There's a couple of cards that do, but we avoid those business cards. So your clean profile stays clean. Now, what that means is we're going to go stack up to 4 business cards together. Typically, we're going things like Chase, American Express, Citibank, liquidated into deployable cash for rehab, holding costs, refinance reserves, working capital if it's a business, and you pay it off at refinance. So you borrowed that capital for free or at a 0% introductory rate with minimum monthly payments. The debt consolidation pathway is specifically designed to get you to the point where this layer is actually available to you. So that's the destination. Now, the sequence that maximizes your approval, whether you're coming in strong or working through the consolidation pathway sequence matters. So this is the order of operations. Get your funding review first, know your numbers before you're under contract and under pressure, assess your pathway. So if you're below that 700 FICO, we determine whether you go straight to gap funding or through consolidation first. And then based on your full file, we lock in gap funding, always before the business credit stacking. Sequence matters so much with all of this. Business credit applications involve pulls. Stacking them first compresses your gap funding approvals. So stack business cards in the right sequence across the right issuers based on your current banking relationships and location once gap funding's in place. Then we're in a position where we can go deploy, close, refinance, rinse and repeat. Pay it all off at refinance or once you solve the project. Personal profile protected, business credit history strengthened, and you're ready for the next deal at higher amounts. So here's the crucial thing to understand, the mistakes that kill approvals, applying in the wrong order. So business credit before gap funding is the most common and most costly mistake. It compresses your gap funding approval at the worst possible time. Paying down the wrong debts first. So people think, oh, yep, got my debt consolidation loan, I'm going to go pay down my auto loans, whereas revolving balances is the key to lowering your DTI. So that's your personal credit cards. And they have the most direct impact on utilization. Paying an installment loan first when you have a maxed card does almost nothing for your approval profile, and it won't have the impact we need to then go and be prepared for 0% stacking. Now, applying for random credit beforehand. Every hard inquiry has a short-term score impact. It's not massive, but it's going to kill your approvals if you're willy-nilly just trying things out without a pre-approval process and an understanding of who to apply for based on your profile. So shopping for car loans, Typically, car salesmen are pretty lazy. They'll just do a couple of hard pulls to see if you even get an approval rather than pre-approving you. So in the 60 days before your funding review, this can cost you big time. Even if it's not disqualifying you, it's going to lower those approval amounts. Waiting until you're under contract. This is what we see so often. People come to me when they're stressed, when they're on the back foot, when they've got no time to spare, which is fine, we'll get you sorted. But this 24 to 72 hour deployment timeline assumes your profile's already reviewed and ready. Don't find out where you stand when you're already on the clock. Get this sorted before hard money or before you've put your seller of finance in place on a business acquisition. So what to do right now? If you score 700 plus in a clean utilization, you're probably closer to ready than you think. So book a funding review. Let's put a number on it. If you score 650 to 699, let's look at the full file. Deals are getting done at this level, and there may be quick wins that move the needle before your next offer. If you are below 650, the consolidation pathway is worth understanding, but you can't even access that. So we always recommend go and utilize an AI software like Dispute Beast. No need to pay a credit repair company hundreds of bucks a month to keep you on the hook. Just get that sorted yourself. It's a lifelong skill you should learn anyway. Get yourself to 650 so you can start hammering through this process. Now, the worst thing you can do is nothing. While you're waiting, investors with clean profiles are buying the deals you're looking at. Book a free funding review at gapfunder.com. Even if you're not ready quite yet, I can give you a good understanding. It only takes 2 minutes. You walk away knowing exactly where you stand, exactly what pathway makes sense for you right now. I'm Mick Wadley, so let's go and close something.